Well, good morning, everybody. And I wanted to kick this webinar off this morning with Phoenix. We have been doing a series of webinars on Phoenix because we've had such a good response to the Phoenix company and their annuity portfolio. And so this is like our fourth or fifth webinar on this Phoenix product and what they have. And we're going to continue to do this in August. We're going to do some advanced sales strategies and some other webinars out there, so stay tuned for some extra webinars on the Phoenix. I think the one that will be coming up on August 12th is going to be really exciting because it's sales strategy instead of just product knowledge and product rollout. So that'll be exciting on August 12th that we'll have that. But this product that we're going to go through today, we have done it before in the past, and we had such an overwhelming questions and people liking this annuity that we decided to do this again because it is one of their more popular annuities that is up and coming on that. I have with me today Ed Federici from Phoenix that's going to do the webinar because their product, why not get it right from the company? So, Ed, if you're there, why don't we get this thing started?
I am. Sounds good, David. Thank you and appreciate your time today. And yes, we've gotten a really great response from all of you on this particular product. What I'll do today is just give you a little history on Phoenix, a little background and some historical facts about the company as well as some current financials. And then I will go through the mechanics of this product, how it works, key target markets, and then I'll also give you a couple of sales ideas that you can put in place right away. And this is actually a newer product for us. It's the latest addition to our portfolio of fixed index annuities. And because of your affiliation with AIM, you have access to this. Not everyone does. This is a limited distribution product, which means it's exclusive, and there's only about 10 firms on the marketplace today that have access to it. So why don't we get started? For those of you not familiar with the Phoenix companies, we have a pretty rich history in the insurance field. Over 160 years in business, backgrounds going all the way back to 1851. A lot of innovation in terms of firsts to the marketplace. 1955, we were the first carrier to offer first reduced premiums for women, first lower rates for non-smokers, and in 82, the first survivorship life policy. We're probably most famously known as being the carrier that insured and paid the claim on President Lincoln. I work with our corporate marketing folks to create a great one-pager that, number one, has all of these factoids. It has our financial information, our statutory results, but I also have them add a great picture of Lincoln. And that's just been marketing dynamite for us, where this is something that you can hand to a client. They're just saying, wow, they've been around since 1851. Wow, they insured Lincoln. It's obviously a very notable figure, but it also just speaks to how long we've been in business. I'm calling you today from this building. We're in Hartford, Connecticut, on the banks of the Connecticut River. And this building, Phoenix had built for us back in the 50s. And it's, in fact, innovative, too. It's the world's first two-sided building, and it's affectionately known as the Boat Building here in Hartford. It's a historical landmark, and it's right on the, as I said, on the riverfront where the city of Hartford's done this huge riverfront recapture. Phoenix donated like $3 million worth of property right across the street, and there's the Connecticut Science Center. So it's just, if you're for those architectural buffs, it's a great building, and it's actually a great place to work. A couple other key facts for you before I move on to the product is, we launched our fixed index annuity lineup back in 2008, and if you all remember that period of time in the marketplace, it was just chaos. It was the worst bear market since the Great Depression, and here we are launching our brand new product suite. So tapping into our innovative roots and what we've done in the past, we decided to be very innovative in launching in such a very poor market. So we did two things. Just knowing the time frame and what was going on in the market, we did two things: one to protect you, and one to protect your clients. And I know we're further from shore from 2008, and things are a little bit different, but these things are still in place today. Number one, we have this embedded supplemental E&O that guards against insolvency, and there's nothing for you to fill out, nothing for you to, no forms, nothing for you to pay. Anyone out there representing us and our products, you're automatically covered by this. And once again, we're much further from shore than 08, but this, people didn't know which end was up back in 08, and so this was really important, more important back then than it is now. But it's still in place. And probably more importantly, for your clients, well, there is not another carrier that has this out there on their fixed index annuity suite. When your clients' assets come into the Phoenix companies, normally what happens is they go into the general account. And the risk is that it's, at the risk of general creditors. So we decided we're going to take a very different approach. So when assets come into our shop for fixed index annuities, they go into a separate account, which means those assets are segregated, separated, and held apart from the general account, adding that additional layer of protection. In terms of financials, right, we're obviously very strictly regulated by the states that we're situs in, and that would be Connecticut and New York. And we have to, maintain reserves to back all of our promises. And those are referred to as statutory results. So currently we have $13 billion in statutory reserves. We have $780 million in surplus. And then there's a figure, I don't want to get all fancy on you, but it's, some people call it the solvency ratio. Others call it RBC, risk-based capital. And essentially, that's a measure of, okay, what are your liabilities and what do you guys have set aside, that you're regulated by the states, what do you guys have set aside? And normally, you want to see a carrier have 200 or better. Like 200 is like the threshold, right? 200%, which means, okay, so for every dollar of liabilities, what do you guys have set aside to cover those? And what's the ratio between those two? So, once again, 200 is like a low threshold. I just wanted to, be clear. Our RBC ratio is 347%, which means that for every dollar of liabilities that we have on the books, we have $3.47 set aside to cover those liabilities, which is obviously a very, very strong number. And by the way, there is a one-pager that has all this information that you can pass along to your client, and we'll make sure that it's available to you after the webinar. And I won't bore you with all this. I'm sure every marketer that gets in front of you talks about the risks that your clients face. And our goal here is to make sure that you're equipped with the product knowledge and the product suite that you can do one thing, and that's, despite all these risks, provide and try to maintain a comfortable lifestyle for your clients when they hit retirement. So it's important for us to have those discussions with your clients, have a dialogue with them, and we think that you need to take a four corners approach when having that dialogue with your client. And that's a key word, dialogue. So listen to your client as to what their fears are in retirement, where do they currently have their assets, right? So these are pretty self-explanatory. Accumulation, and I'd say accumulation and protection, right? Because accumulation could just be a brokerage account. Given where the market is, and I know it's been volatile of late, but we've seen new highs in the market. So folks have forgotten all about the pain that they experienced in the last two bear markets that we've experienced, and there's this euphoria of being in the market. So folks have been really cognizant of products that offer some sort of accumulation feature. And I would once again say accumulation and protection. Income, obviously having sources above and beyond a pension or Social Security. Family protection, this could be life insurance or it could be an annuity that has an enhanced death benefit on it. And last but not least, a very important pillar of this is care, personal care. So that would be, say, for example, if a client could not perform 2 out of 6 ADLs, or worse, they're confined to a nursing home. We actually have, fixed index annuity products that will take income and then have a multiplier on it if they're faced with some sort of personal care item, or issue, I should say. So this is the four corners approach. Once again, we have been very cognizant of building a product lineup that helps you address those four corners. And once again, let's just go back to this. If you're in a dialogue with your client and they're talking about, well, I've got a brokerage account or I've got a managed account, I'm in American funds, what they're telling you is that their retirement savings mindset, methodology, has been using accumulation products, right? So I would listen to that as, okay, this is the vehicles that they've been using, accumulation as being a key feature. On the other side, with protection, what type of annuity product do we have that can fit that needs? On the other hand, if your client's saying, well, you know, I had a pension, but they stopped it on me, and I'm really concerned about Social Security because I know when I retire, you know, I'm going to have my taxes I have to pay, I'm going to have my utilities bill, I'm going to have my heating bill, right? So they're thinking more about income and expense. So by having that dialogue, right, you can point and shoot them in the right direction from a product perspective, which this is our platform. And what I'm going to really focus on today is our personal retirement choice. I would just have you note that, once again, we've been very cognizant and been very methodical of adding products that, number one, complement one another and fit that bill of having some feature that would fit that four points. So personal retirement choice, this is our accumulation product, and you see it's color-coded, right? So there's an optional income rider. If your client is saying, if all they're talking about is income and expenses, well, then our personal income annuity, which is the webinar we did a couple weeks ago, might be the right fit for them. And this is all about maximizing income in retirement. On the other hand, if your clients, maybe they haven't purchased life insurance, maybe they don't have a long-term care product, this is our combo product, so that if your client has to stretch their assets to cover multiple needs, it has an income rider. If they're confined to a nursing home, it takes that income, multiplies it by 250%. And I'm also pleased to tell you that we have the best enhanced death benefit in the business today. This thing rolls up at 10%, simple, and then it's paid out as a lump sum to the beneficiaries. So I think you can kind of get the point here. In each class and category, we have a best-in-class feature that we think makes our product lineup very, very attractive to you and to your end client. And with personal retirement choice, which I'll focus on in just a minute, you know, the sizzle here is up to a 15% upfront premium bonus added right to the account on day one, and a couple of new for us, Uncap strategies that really allow us to participate in that upside of the market. So let's get into some of the details. Obviously, you know, this one is focused on accumulation. I would suggest, though, you're going to see, I'm going to give you some examples of how the income works on this. And when I was first, you know, trained on the product, I was thinking strictly this is accumulation. But I think you're going to see that this is has a great optional income rider. So I'm going to say that this is our growth and income strategy. So for your clients interested in growth and this optional, you know, income rider, I think you're going to be very pleased. So some of the basics. Issue age for clients 0 to 80. Premium on the low end 15,000. We'll, you know, up to $1 million. And by the way, we can make exceptions on both ends. And I think I can speak for David. We love making exceptions above the $1 million mark. Those are the ones that we love to work on. And the accumulation. So you're going to see in just one quick slide, depending on the client's state and whether or not they elect the income rider, they're going to be looking at up anywhere from an 8% premium bonus up to a 15%. Okay, and I'll show you how that works. 5 index accounts, including those 2 uncapped, and I'll show you how those work as well as a fixed account. And then an income rider that is optional. So the cost for the rider, so obviously the cost for just accumulation, right, getting into the crediting strategies, there's no cost. And there's some cool things I'm going to show you how that works. But if the client says, well, you know, I'm interested in growth, but I want to turn on some income down the road. So we have this optional income rider that costs 95 basis points. And what we do is, just to keep this simple, so say a client has $100,000 and they're in a state where there's a 15% bonus. So obviously on day one in their account, there'll be $115,000 in the account. So that also creates our income benefit base. So the account has $115,000, the income benefit base is also $115,000. So that creates that benefit base. That rolls up at 8% simple for 12 years. And then you've got the option to restart that for another 12. So I'm going to just share with you, I was pleasantly surprised as I really dug into the product, worked on some illustrations. You're going to find this to be a very, very strong optional income rider should your client want to go that route. All right, I know there's a lot of columns on here, but I think it's important to look at. So on this side of the column, or this table, this is the premium bonus. So in these states, and I'll let this slide stick up here for a little bit. So if you're in, you know, Florida, Tennessee, West Virginia, Wyoming, Vermont, right? if you're in these states, the client has access to the rider that, the product that has up to a 15% premium bonus. However, it has to be, the income rider has to be elected. Let me just say that another way. To get the 15%, the client has to elect the income rider. If the client says, you know, David, I'm not interested in paying for an income rider, I'm just, you know, I just want accumulation, well, that's fine. They don't have to elect the income rider, but they'll get a 12% premium bonus at no cost. So still a very, very strong number. And if you're in Florida, you know, we've done something very unique. For clients 64 and under, they can get at this. 65 and over, they're going to get at an 8% premium bonus. So you can see across the board, 8% roll-up on the income benefit base for 12 years. What you'll see is in these states, the light or IIC states as they're called, you're going to get an 8% premium bonus, which is still very, very good in those states. And you see, you know, higher ABA payout factors, which means that they're just going to get a little bit higher income should they elect the income rider as compared to, so it's kind of in lieu of getting the 15%, they'll get 8 and a little bit higher income. Surrender charge. So this is how we're getting at such a high premium bonus. I always get, this is too good to be true. How do you guys do this? Well, it's pretty simple. We have our normal products have a 10-year chassis. This product has a 12-year chassis, so a longer surrender charge period. And the free withdrawal amount is 7%. Now, to be clear, it's 7% of the initial premium plus the bonus. So in the example I gave you, 100 plus 15, it'd be 7% of 115,000. So that's how we're able to get at such a high upfront premium bonus. Is a little bit longer surrender charge and a little bit lower withdrawal amount. But I'm going to share with you a couple sales ideas using this free withdrawal amount that's going to just show off how flexible the product is and, quite frankly, how good the income is as well. All right, so
yes,
sir.
Can I interrupt there 1 second? If you
Yes.
go back to the screen. Okay. Also make note, because a lot of the people in our area are out of Washington and Oregon, that the product's a 10-year product with a up to 10%, and it does only have the 8%, but I'll tell you what, with the very small product offerings that there are in Washington and Oregon, this is a very attractive product because you can get up to 10%, and it is only a 10-year product. One other comment is I have noticed with a lot of annuity carriers how they've been cutting back on their caps and that type of thing. As Ed goes through this presentation, please pay attention to a couple of the strategies that don't have caps on them, because you get someone into a product and caps start to change and that type of thing. This is where this product kind of stands out with having some strategies that don't have caps on it. Go ahead.
And I'm sorry I missed that. You're actually absolutely right, and that's where we're absolutely making some traction due to how we've designed the product for Oregon and Washington. So that's great segue, because with the point-to-point crediting strategies, a couple comments. It's all based on the S&P. So there's nothing esoteric or hard to explain. They're pretty simple, monthly, 1 year, 2 year. But then we've added, and this is new for us, Uncap strategies that have participation rates. So the 1 year on the S&P has a 30% participation rate, and the 2 year on the S&P has a 40% participation rate. So before I get into any of the more kind of advanced ideas of how to use this product, I'll just show you a very simple example, and this is like a typical client that may use the product. Anthony's age 60. His goal is to accumulate. Maybe he's coming out of a brokerage account, and that's what he's used to. But he's now concerned about protecting those assets. And he has a secondary goal. Maybe he's going to work till 65, work part-time. Maybe he's going to turn on Social Security, but he's not going to turn on the income until he's 72. So he has the wherewithal to let that roll. And I told you up front that I think you're going to be really pleased with the income. So in this example where Anthony put in 100 grand, he'll have 115 in the account on day one, so an immediate 15% return. And because he's elected the rider, when he does turn it on, he's going to be looking at a $12,059 guaranteed income stream. All right? So to put that into perspective, as I said, this is, in my mind, was an accumulation product, but as I played around with this, that's a 12.1% GMWB. So it's a great optional, income story if you want to go that route. And to be able to show your client in this rate environment where, what are CDs paying? What is their bank paying? To get at 15% immediate return and then a double-digit GMWB, I think you can see why this product has become, so popular for us. All right, so I know there's a lot of bars on this chart, but let's go through this. These are values at year 12, using Anthony as an example. So he started with 100, and TGV, total guaranteed values, just assume this is just worst case scenario. This assumes over the 12 years there's zero growth. The market does nothing. The only thing that's coming out is as fees. So under the terms of the contract, we have this total guaranteed value, which basically says, look, if things are horrible, you'll get 87.5% of your starting premium. You can't go below that. Number two, I just want to share with you, this is, if you look at the notes, this is a hypothetical using the S&P, and by the way, we're now able to illustrate this on our illustration tool. But this is, if Anthony went into the 1-year point-to-point on the S&P with the 30% participation rate. So his 100 grand with zero downside risk. He's got this great income rider. He's got a 15% immediate return. His 100 grows to over $151,000. So that's a great growth story. His benefit base. So remember, if you put in 100, he'll have 115. That creates the base, and that's going to roll up at 8% over the 12 years. That number is 225,400. We then use that base to calculate his income number, which is $12,059, or 12.1%. The final column is just a look at the cumulative income he'll be pulling out over time. So he started at 72. By the time he's 75, he would have pulled out a cumulative $48,236. Should he live to age 85, he would have pulled out in guaranteed income $168,826. And should he live to an advanced age, say age 95, $289,416 in guaranteed income pulled out of this growth and income story. So once again, that's nearly 3 times his premium has been pulled out in income in a great accumulation story, but a great growth and income story as well. So I was at a meeting in Las Vegas, and was presenting to about 500 agents. And there was, after the meeting, I'm in the back of the room, and we've got a booth and a display. Excuse me, and I had an agent come up who's actually also an advisor. So he's actually more new to the insurance side than he is to doing brokerage accounts and managed accounts. And he came up and he said, Ed, and I just kind of walk through what I just went through today. And he said, Ed, this is a great product. In my mind, this is a mutual fund killer. So that got me thinking, and I created some additional slides with that thought in mind. This is a mutual fund killer. So when I think of mutual funds, I think of IRA rollovers. And why is that? There's a couple of reasons. Little funny title to the slide, the booming rollover market. So obviously it's growing rapidly, right? But it's also being fueled by baby boomers. Okay, so in 2012, these are assets that are being rolled over. Somebody has a 401k, they retire, they roll it over. Somebody's retiring, and they roll their assets over, and they're counting on that to provide a lifetime of income. So in 2012, $393 billion, that's with a B, was rolled over. And that's projected to grow to $575 billion by 2016. If you kind of dig a little bit deeper, more than half of these accounts, when people roll it over, they're at 100 grand or more. 25% of the accounts, when people roll it over, they have balances of $250,000 or more. So this is a great opportunity for us from a market share perspective. And I'm just going to give you a quick story anecdotally here. I have a friend who is now 59 years old and very highly educated, very smart person, and is retiring in a few years. And this is now many months ago. She came up to me and we were talking at a dinner party, and she said, I'm very proud of myself. I just did my IRA rollover. I said, Deb, that's great. What did you do? And she said, well, I talked to my advisor, and we opened a managed account. So that's not a bad thing, right? So in the managed account, you can actually, You can actually purchase annuities in the managed account. Maybe they're doing some alternative strategies, maybe a bond ladder. So I pressed her a little bit more. I said, well, Deb, what did he put you in? Well, he put me in American funds. So here's a highly educated person. She's worked her entire life. She's a few years away from retirement. We're at a market peak, and her advisor put her in American funds. So I said, Deb, what funds did he put you in? And she looked at me and she said, I don't know. So here's a great opportunity for us. It could be an oh, by the way question. How are you protecting? We're at a market high. How are you protecting your retirement assets? What are you doing to protect those assets? Because I'll tell you, my friend Deb is not alone. When people roll over their money, they're putting them in stock and bond mutual funds, individual stocks, ETFs, managed accounts, just like my friend Deb. 78% of the assets are in the market. They're exposed to the market. Once again, people love it when it's a bull market. They've forgotten all about the pain they've been through. They've forgotten that the pool has been drained twice on them, right? Now there's the other side where people are so paralyzed that they're actually putting money in a checking account. They're rolling money over to a savings account or money market funds that are earning just a little bit north of zero. So here's a great opportunity, oh, by the way question. And here's a product that can deliver both on the accumulation side and the income side should the client want to go that route. So we've gone through how the product works. I've given you a basic example of how the income works, how the premium bonus works, and now I'm going to share with you kind of an advanced sales strategy. So this is for a client. I call it the 4% freebie, right? Because we have an optional income rider here. So the client does not have to turn on the income. So David, I'm interested in this product. I'm in a brokerage account. I don't believe in paying for income, and I've got a pension, and I'm okay. But I do want the upside, and I'm at an age where I need to protect against the downside. So I'm interested in your product. So let's just look at some of the assumptions here. Here's a client age 65. They've got $100,000 in premium, and because they have not elected the rider, instead of 15, they're going to get 12, which is still great, and there's no charge to the client. What I've done here is I've split the assets up between our two Uncap strategies, right? Our one-year point-to-point has a 30% participation rate. The two-year has a 40%. So I've just diversified and split the assets equally weighted into both to get exposure to both. All right. So here's how you use that liquidity feature. Remember I said we have a 7% penalty-free withdrawal privilege? So despite the client not wanting to pay a fee, you can show them that we can create an income stream for free using the penalty-free withdrawal. So they've put in 100, and what we're going to do is in year one, we're going to start taking out $4,000. That's 4% of their starting premium, and we do that each and every year. All right, so this is an important column to look at. This is our withdrawals, penalty-free. There's no rider. This is not the GMWB. So we do this for 19 years, okay? And when the client turns 85 in the 20th year, they have taken out $76,000 in this 4% freebie. They started with 100, so that's 76% of the assets have been taken out over this 20-year period. The other important column, remember when we're in those two uncapped strategies, is the accumulation value. This is non-guaranteed, right? So this is these aren't caps, so to speak, in the traditional sense. This is an uncapped strategy, and this is using the S&P back-tested results. Okay, so after taking out all that dough, 76%, they still have 102,000 left over. So to me, this speaks to, one, this is an incredibly flexible product. We can create a free 4% income stream. Number two, as I said, this accumulation feature, and going back to what that agent said to me, this is a mutual fund buster. So you've taken out all this money, and you start off with 100, you end with a little bit more than you started. So very flexible and a great accumulation strategy at no cost to your client. Okay, another segment. So we talked about the rollover market. So we talked a little bit about qualified money. Here's another way to use the penalty-free for a client who may not need the income, say they're all set on the income side, and maybe have some qualified money that, you know what, even though they're set on the income side, the IRS is going to require them to take out their RMD once they turn 70 and a half. Why is this important? $5 trillion are in the hands of pre-retirees or retirees who need our help, guidance, and strategies and solutions to handle their RMDs. Think about my friend Deb, who was so proud she thought she was doing the right thing and rolled her money into a managed account. How many of these clients, right, are like my friend who don't have a clue, right, where they've put their assets? So let's just look at this. This is pre-retirees. So these are folks 60 to 69 who have to start planning to take their RMDs by 70 and a half. They have 1.5 trillion with a T in assets. And like my friend Deb, they're either exposed to the market or they're the other side of the coin where they're in a vehicle earning just a little bit north of zero. The only difference here is these are pre-retirees. This is partially retired folks, maybe working part-time, or fully retired folks. These folks have 3.5 trillion in assets. This could be an oh, by the way question, just like on the rollovers. You're like, how are you handling your RMDs? How are you protecting those assets? This could open up a whole world of business for you. So with that, let's use this product, Personal Retirement Choice. No income rider, so similar scenario to the last example. No income rider, and we're going to address RMDs. So the client's 69. They have $275,000 that they've rolled over, right? And because they've not elected the income rider, they'll get a 12% premium bonus. I put all the assets in this particular case in the 2-year point-to-point, which is a 40% participation rate. So what I've done is the client's got $275,000. I've gone online. You can go to Fidelity. You can go to T. Rowe Price. Go to Google. Type in RMD calculator. They're out there for free, easy to use. You can get this done in 2 minutes. So I went to an online calculator, and I figured out age 69, $275,000, what would their RMDs be? And I've plugged those in, and I've pulled out the RMDs each and every year. So once again, the client is not paying for a rider. We're using the liquidity feature to take out those RMDs. So when the client turns 79, 10 years down the road, they've taken out over $88,000 from the contract in RMDs. They've satisfied those requirements. And I'm just, they could keep doing that. I just wanted to, do a point in time here. So at 79, they started with 275. They've taken out 88,000 in RMDs, and they have 318,000 more than that left. So they have 43,000 more than they started. So once again, flexibility to handle RMDs, an income stream, whatever the case may be, and just a really, really strong, accumulation story as well. Now that we have these Uncap strategies. So what's their alternative? We saw that chart from LIMRA that shows 78% of folks are in the market. Like my friend Deb, who went into a managed account. She's in American funds. Nothing wrong with American funds. Probably paying on average a point for the funds. Advisors usually take a point of the assets under management. There's 12B1 fees on the mutual funds, and managed account platforms start at 50 basis points. Some go up to 75. So my friend Deb, who's a few years away from retirement, is paying probably really close to 2.75% coming out of her account each and every year for the privilege of being in a managed account. And maybe if you're younger, that might be a right decision. Maybe Deb should keep a portion of her assets here, right, for discretionary expenses. But for somebody who has, a few years away, I ask the question, what's the value proposition of a pre-retiree, a boomer, being in an advisory account? It all in. It just doesn't make sense to me. So I think I've just given you a couple of ideas of how, like my friend Deb, could get into a product that offers protection, great upside with a very high bonus, and uncapped strategies for free, right? There's almost no comparison, like that agent told me. Mutual fund, there's almost no comparison between the two. All right, so yes, sir.
Can I interrupt again? Just real quick, it's a question to you, Ed. Is this like this slide that you just had up here? Is this available to agents to put in for a presentation that they could use showing what the costs are for running money through a mutual fund versus just having a straight annuity?
It is not. This is actually for agent use only, and to be, and we can talk offline here. Unfortunately, we've had some folks in the past take some of our agent-only material, change them, get it in front of a client, and they've got themselves in trouble. So I can no longer send out our agent use material. So I apologize for that.
Okay, but do you have marketing materials similar to something like this, or what does Phoenix have available as far as marketing materials for, getting the annuities ideas across to other clients that are in different types of funds?
Yeah, let me go to our. So one other thing we wanted to just highlight today, we have a new web portal. It's called SalesNet. I'll send the link over to David. And a little bit different, I believe to get into the marketing materials, you do not need to log in. But if you're getting into our quotes, we're going to ask you to create a user profile. But essentially, in our marketing catalog, oh, that's the wrong area. We want to get into
marketing.
Yeah.
And the reason for everyone that's on the phone and on the webinar that I brought this up is because, most of the brochures out there in the annuity market are, they're nice, but there's a lot of material out there that these carriers come up with that make your job a whole lot easier on presenting ideas and reasons to move money over from one place to another. And a lot of people don't even realize that those are available out there, and I'm just trying to make sure that you're aware of the different materials that Phoenix has developed to help you make sales out there, and I want you to take advantage of it.
Yeah, so here's our standard client brochure, which goes through. I think this is actually pretty strong, right? So we kind of talked about this up front about having a dialogue with your client and listen to what they're telling you about, is it coming from a brokerage account, and that kind of point and shoot you to the right product and right strategy. But this is actually very, very powerful, and that is, when somebody retires, some of the bills are just not going to go away, right? So you've got your housing expenses, rent, taxes on the property, if that's applicable. You're paying for food, you're paying for utilities. Those are going to come each and every month no matter what. And to cover those, you need something that is reliable, consistent, protected. And the only three options of guaranteed, money would be a pension, Social Security, and annuity. Pensions, not a lot of folks have them, or they've been like I can tell you from my own personal experience, I have a pension, but at a certain point at time, and there was a cutoff. They're no longer, I'm capped, if you will, at a certain level. Other folks were grandfathered. Social Security, right? There's dialogue about that being, becoming insolvent at a certain point in time. So these are the three avenues, and annuity is a great one to, use for these consistent expenses that are going to come each and every month. And typically, these represent 60 to 70% of a retiree's expenses and need for retirement income. On the other hand, like my friend Deb, right, don't go all into a managed account. Maybe you keep some of it in the market, but these can be used for discretionary. So if the market's up, take that vacation. If the market's down, you got to be a little bit more frugal. And let's just go to, let's see, what else? There's one other thing that I could send from a PowerPoint perspective, and let me see if I can dig this out. We have something that is called Plan Right, Retire Right, and it's a client-approved presentation that I can send to David, and it's actually quite good. It goes through the risks that that folks face in retirement, and once again, client-friendly. There's a script that you can use. You can, place your name on it. I'll just go through this very quickly. How retirement has changed, right? How it used to be, how it is today. This is a look at, the responsibility is shifted to investors, right, from defined benefit to defined contribution, right? So a lot of people had pensions. That's down to 7. The shift has gone to people having 401ks, 403bs. Healthcare coverage. Once again, I'm going through this kind of quickly here. The risks that you can have a discussion with your clients. Longevity, cost of healthcare, inflation, right? So that's a great case for annuities. You want to be in the market. The rule or the old saw was that, the way to hedge inflation, you got to be in stocks, right? Well, here's a way to participate in stocks or the upside of the market through crediting strategies with no downside. Here is a look at stocks, bonds, and short-term and volatility. Portfolio A and B. This is actually really great. Both portfolios have returned 6%, but the ride for each client has been dramatically different, and that ride can make a huge difference in terms of, what the client's end value is, depending on when they turn on or when they retire, right? So different returns. This client winds up with 292 when they're ready to retire. This client winds up with 562. Anyway, this is what's in the client brochure. This is a very powerful presentation, coupled with, right? So you're coming in talking about concepts, having a dialogue, finding out what's important for the client, and then once again we have the product material that you can then close with. And I would also say that probably our most powerful tool here is our quoting tool. Let me actually show you one other item while we're talking about marketing tools, if that's okay, David.
Yeah, go right ahead. And while he's bringing this up, is if you are interested in any of this, please don't hesitate to send me an email, and I'll make sure that you get what we're showing you here. And I think again it's important that you have the tools out there to make the sale, and that these companies have developed them. We ought to use them because they're just going to be helpful getting your points across to the clients. I know when it comes to annuity sales, it's not a complicated deal, but it's about moving money from one place to another. But there's a lot of sales ideas brought up in these things that should make your job a lot easier.
So you can see, once you log in, you have access to our quoting tool, which I'll show you. Then we also have something called Realize, and this has been out there for a couple years now. There are some folks that are using this with great success. So this is something that you could, if you're out talking to a client and you have your laptop or a tablet, an iPad, you can pull this up. And what this is a story about the risks of retirement. So you can see, right, we just went through that Plan Right, Retire Right PowerPoint. So you can see there's slides here, essentially, of how the retirement picture has changed. Look familiar? So let me get your name, David Wayne. When do you plan to retire? When do you want to plan on taking income? Sounds great. The responsibility has really shifted to you, David, for taking care of your retirement. By the way, what's the value of your 401k? Do you have an IRA? Yeah, sure. And so the point being is you're telling a story, you're collecting data on the client. And I'm going to go through this quickly to be respectful of your time. But slides look familiar, correct? So once again, I didn't plug in anything, but you can be as high level as you want or as detailed as you want. Just click here. You can get into more income sources. Click OK. You can really get detailed as to their expenses: shelter, food, health care, transportation, insurance, personal care, other, right? Hobby, sports. It's really terrific. And then evaluate solutions. So this brings you over. You've just collected all this information. It brings you over to our quoting tool. And let's go to Washington. Here's the products available in Washington. Here's the guaranteed income amount. And by the way, our quotes are only a couple pages long on personal income annuity. And all that data that you just collected on the client, you can print out a custom report based on what you've collected from the client. You can save this, you can print it, you can email it to your client. It's a great marketing piece that you can leave behind with the client. The other part is, if you really want to get fancy, you can print out this quote, right? E-app. So if any of you guys are technologically proficient, you can then, you've just collected a lot of data. You've essentially gone through some suitability questions as well as you're collecting income and expenses. Now you can see that, right, I've just gone into our e-app. I've not plugged in a lot, but the forms are 71% complete. Now, once again, this could be used from a tablet, a laptop, and you could submit business electronically to our new business area. You have a home area here that you can save applications, build a new applications, all your applications. It's a pretty flexible tool. So I went off a little bit of tangent here on some of our marketing stuff, but we're pretty proud of that. All right, so just in an effort of time here, I'm going to wrap this. Actually, this is a good idea. I'll just do this briefly. You can also use this product. A lot of folks are doing seminars on Social Security. So I created this idea called Social Security Solver, and I'll tee this up for you, where you have a husband and wife. He's 65, the wife is 62, and they're counting on Social Security as their source of guaranteed income, right, to cover those expenses that they have each and every month. And they're getting $2,500 per month or $30,000 a year from Social Security. However, there could be an issue. If the husband were to pass away, the widow is going to see a reduction in that Social Security benefit, right? It's going to go from $2,500 down to $1,500. So that's a $1,000 per month shortfall for the widow. That's $12,000 per year shortfall. And if the widow lives to an advanced age, or life expectancy, I should say, 86, that's a $288,000 shortfall for the widow. So you can use personal retirement choice. Here's female, age 62, $275,000 could be proceeds from the life insurance on her husband. She elects the income rider. She's going to get the 15% bonus, and we're using the Uncap Strategy. So what we do is we use that penalty-free. So she has an income rider. We're letting that continue to roll up, but in the meantime, we're taking out that $12,000 shortfall each and every year for 8 years. So we've made up the difference in the shortfall from Social Security and the difference of what she was getting when her husband was alive and then what she would be getting after her husband passed away. And I just want you to look at this point. When she turns 70 and she decides to turn on that GMWB, it would be $18,744. Two observations. One, her last withdrawal was $12,000. This is a nice leap from $12,000 to over $18,000. The second observation, even after taking out all this money, that's a 6.8% GMWB. And once again, this is our accumulation product. This is our growth, and as you can see, income strategy. So we went through some of the marketing materials. We have a interactive client brochure on personal retirement choice. What that means is there are graphs and areas for you to have your client write in information in the client brochure, which will lead them to what crediting strategies they should use. Do they want the income rider or not? It's very, very well done. And then our quoting tool. I won't go through it at this point in time, but essentially, you saw some of the quotes actually on our screen where you can get at what the income would be. You can use penalty-free withdrawals. You can get at the accumulation value based on the crediting strategies, doing a look back based on some back testing. It's a very, very powerful tool. It's a little bit more detailed than the quoting tool I just showed you online, but it allows you to do a real lot for the client. So why don't I just finish, David, with where we started, and that is our entire product lineup. We've obviously focused on our brand new exclusive limited distribution product, personal retirement choice. 15% in the high states, with an income rider elected, 12% without, 8% in other states. In Washington and Oregon, it's 8%, a little bit higher income, and a 10-year chassis with a 10% penalty-free. Uncapped strategies. Our personal income annuity, which is our pure income play that has either a 45% bonus, up to a 45% bonus on the income benefit base, or a 14% simple roll-up, and we can have that discussion at a separate time. It's a very, very strong income product, and personal protection choice. Remember, this is our combo products. If your client has to stretch their assets to cover income, nursing home, enhanced death benefit, this is one of the best products in the marketplace today, particularly around our enhanced death benefit that rolls up at 10% and is paid out as a lump sum. So with that, I'll just leave you with, and by the way, I'm glad to answer any questions with the time that we have left. If you want a copy of the brochure, and Dave, totally up to you. If you want them to call your office or our office, we're happy to run quotes, send materials out, whatever is most convenient for you, or whatever, however you want to run it.
You know, Ed, it's up to their option. They go any direction they'd like, whatever most convenient for them.
Okay, great, great. So with that, if you know, David, have you gotten any questions in?
Well, let's just open up the mic and see if there is any questions on this. One last point that I want to one thing that I wanted to make sure that I get a point across is that there's a series of these webinars, and we're going to do, as Ed has done today, shared some strategies. The next one's August 12th, which is going to be just on different strategies on selling annuities. And I think it's going to be where people are looking for ideas on ways to talk to their clients about different ways and reasons why they would do business with them, and give them tools, not just a product, but tools on how to sell an income annuity or different types of an accumulation annuity and that type of thing. I think it'll be a very exciting webinar, and again, it's August 12th. So with that, I'm going to open up the mic, and if there's any questions, please ask away. I'm having troubles opening up the mic, so bear with me 1 second. Well, I'm not able to open up the mic, so if you have questions, please send me an email, and I'll make sure that they get answered. With that, Ed, let's close it up for today, and remember, August 12th, we'll have another webinar with Phoenix. Thanks, everybody.